Why your dependent children, if they are working, should file a tax return. Now, I've done a video along these lines probably about 6 months or so ago, in which I was using that to argue, in fact, on behalf of my book, The Tax Bomb in Your Retirement Accounts, so your child could do a Roth because they had to earn income. And that generated a lot of comments, a lot of watch time and whatnot. So I'm going to follow up though with an article that from the Journal for Financial Planning. I'm not sure I can't remember what date that was, last year sometime. I'm going through my stack of old JFP issues back there, and I'm coming up with a couple articles I want to share with you. This one from Randy Gardner, who's a professor. He's been writing in the JFP for a long, long time. He's the founder of Goals Gap Planning LLC in Laguna Beach. He used to be the professor at University of Kansas or University of Missouri, Kansas City for a long time. LLM, and I forgot what that stands for. I forgot what it stands for. But he's a CPA, CFP, and his partner, Julie Welch. I'm not all that familiar with her. She's at Leawood, Kansas. She's with Mira Welch Brown. So LLM, the tax planning law degree, some master's level of taxation understanding. So understanding taxation of dependent children's income after the TCJA is what we're going to talk about here. So before we continue, smash, my friends, smash. Hit the like button. That's the smash. What's the other one? You want to comment. Just say anything. I mean, that'll help with the algorithm. And so if you have children, just answer this yes or no, because believe it or not, a yes or no answer helps me immensely with the algorithm. In this day and age, with so many more competition out there, which is great, it's wonderful, I got to keep in front of the comp by asking you to contribute with a simple yes or no. Do your children work? Yes, they work. No, they don't. That's all I got to say, yes or no. All right, do your children work? And I guess that'd be more along the lines of dependent children. So mine do, all right, or at least one of my four does. The other one will go get a job next year as well. All right, so this is from what dateline was this? I think it was May of 2018 or maybe June of 2018. I can't remember. But let's read this. Understanding the taxation of dependent children's income after tax reform. Lots of wonderful stuff in here, my friends. Let's see if I can't make this bigger. I got to stand up because my arm is such a mess. Yeah, why can't I get that to work? Option. Sometimes it works and sometimes it doesn't. I don't understand it. All right. Well, anyway, so you might not be able to read that, but I will put a link in the show notes. And I just dropped my pillow there. Hold on just a second. I am a hot mess here today, my friends. Hold on. There we go. All right. So the tax cut, the TCJA, Tax Cut and Jobs Act, made several changes to the way dependent children's earned and unearned income are taxed for the tax years 2018 through 2025. Who is treated as a dependent child? Under 2018 law, the definition of a dependent child remains unchanged and includes any child of the taxpayer who is under the age of 18, under the age of 19, and does not provide more than half of his own support with earned income, or is under the age of 24, a full-time student, and does not provide more than half of his support with earned income. Remember, earned or unearned. When talking about the taxation of children, it's important to distinguish between the two, earned and unearned. So we're going to talk about earned right now. Earned income means wages, tips, and other amounts received as compensation for personal services, but does not include corporate distributions of earnings and profits. Capital gains, qualified dividends, and interest income does not include that. If the child is a sole proprietor or a partner in a trade or business in which capital is not an income-producing factor, such as babysitting or dog walking business, and the child's personal services produce a business income, all of the child's income is considered earned income. Does that make sense? So if they got a babysit production thing, a dog walking, we're picking up poop, we used to call poop patrol, none of that is considered unearned. It's all earned income, which is good. We're going to talk about that. If both personal services and capital are material income producing factors, such as a manufacturing business, then a reasonable allowance for compensation for personal services up to 30% of the child's net profits could be treated as earned income. You don't need to get that detailed. Just remember, my inclination is if the kid is working, make it earned income. That's all there is to it. But I don't want to pay FICA. Oh, we're going to get all that. Earned income planning opportunities, huge planning opportunities for earned income children. So Maddie was 17, 18 last year. She's working as a a hostess for a country club a couple of miles away. She worked as what else did she do? She did that. She did some, I'm drawing a blank what else she did. But anyway, I forgot. But she did a couple things for earned income. She was making earned income. She was 17, 18 years old. She was still a dependent of me. I think she made like $4,000, $5,000 or something like that. And again, we made her file a tax return because she got all the money back. And I'll share with you why. Dependent children, she was 18 and had less than half, she was under the age of 18, 17 with less than half of her income. We'll just go back to it. Dependent children. She was under the age of 18, first and foremost. Under the age of 18, you're dependent. That's all there's to it. Now she's under the age of 19 and does not provide more than half of her or her own support through earned income. So she's a dependent child. Does that make sense? Or she could be under the age of 24, a full-time student, and does not provide more. So in this case, when she was under the age of 18, she's a dependent child. That's all there is to it. Over the age of 18, or 18 years old, I will just say that, 18 years old does not provide more than half of her income through earned income, or half of her support. So she is dependent on my wife and me. All right. The acts of repeal of the exemption, dependent children with earned income are generally better off under the new law. The TCJA, the Trump tax bill, repeals of the exemption deduction does not affect these children because their standard deduction, because their parents claim the exemption deduction under pre-tax law. However, the increase in the standard deduction to $12,000 in 2018 significantly increases the amount of earnings dependent children can receive before being subject to federal income taxes. This is where everyone makes a mistake. You don't get the personal exemptions anymore. That is correct. There are no personal exemptions. I don't have an exemption for Maddie, my oldest, anymore. All right, because I don't have an exemption for anybody. And the people are like, well, I got to pay tax. No, because her standard deduction for Maddie has gone from $6,350 to $12,000 in 2018, significantly increasing the earnings she can receive before being subject to federal income tax. Unless employed by a parent, children remain subject to payroll taxes on wages earned and net income from self-employment over $400. Self-employed parents should hire their kids. Generally, the children will be in a lower tax bracket than the parents, allowing the shifting of income from a higher tax rate bracket to the children's lower tax rate bracket. A parent, as the employer, does not need to withhold or pay Social Security tax on a child under the age of 18. So remember that? I don't want to have to pay FICA. You don't have to if the kid is under the age of 18. Or the parent won't have to pay federal unemployment tax on the wages of a child under the age of 21. So you don't have to pay unemployment or FICA if the kid's under the age of 18, and you don't have to pay unemployment taxes on the wages of a child if the kid is under the age of 21. You still have to pay FICA. Because of this favorable treatment, wages paid by parents to children are scrutinized closely by the IRS. I'm telling you, the absolute 100% big red flag. Be sure the wages paid are directly connected to the parent's business, reasonable in amount, and for services the parents can prove are provided by the child. An example, they give us an example here. The parent is married in a 24% tax bracket and subject to self-employment tax. If the parent has business filing, typing, or other chores the child can help with, the parent can deduct the child's wages against the parent's business income. If the parent paid the 16-year-old child $12,000 in 2018, the approximate savings would be, so remember, 16-year-old child, you do not have to pay FICA. Parent savings from deducting the wages, federal tax at 24%, they get the right $12,000 off at 24%, plus self-employment tax of 15.3, that's FICA on both sides, 7.65 to the employee, 7.65 to the employer. In this case, they're paying both sides of it. So they're going to save $4,700 in taxes by making the kid get that $12,000 as opposed to the parent. Child's tax, assuming no other income, wages of $12,000, the standard deduction of $12,000, and taxable income of nothing. Federal income and payroll tax for a total tax savings to the family of $4,700. The kid doesn't pay any taxes. The parents get a tax write-off of $4,700, but the kid still gets $12,000 in total income. Pays no taxes. It only costs the parent in this case, what, $8,200 or something like that. Additionally, the child is now eligible to contribute to a retirement account, an IRA or Roth. In the above example, if the child contributes $5,500 to the deductible IRA, the child could earn it up to $17,500 and still pay no federal income tax. Alternatively, earnings up to $5,500 could lead to a Roth contribution. So they already have the earnings. I mean, you got $12,000 of earnings, they can contribute to a Roth, which they absolutely should do here because there's no reason to take a tax deduction in which you're not getting any deduction anyway because you got no income tax. All right, so effective the kiddie tax on investment income. Before 1986, parents shifted investments to children so that interest, dividend, capital gain income from the investments would be reported on the children's returns. Often, little or no tax was paid because they shelter the investment income with their standard deduction, an exemption deduction, and paid tax at the children's low tax rates. Congress changed all that in 1986. So first, if the parents claim the child as a dependent on the return, the child's standard deduction decreased to the greater of $1,050 or the child's compensation plus $350 up to the single standard deduction amount. The limitation on the child's standard deduction continues to apply under the new law. So remember, the standard deduction decreased to the greater of $1,550 or the child's compensation plus $350. All right, but again, that's on what? Kiddie tax investment income, not on earned income. The limitation of the child standard deduction continues after the new law. Thus, if the child's compensation is $500, the child's standard deduction is $1,050. If the child's compensation is $2,400, the child's standard deduction is $2,400 plus the $350. Does that make sense? Because it's the limitation. The standard deduction is decreased to the greater of $1,050 or their income plus their compensation income, earned income plus $350. So Maddie last year, in fact, I had her tax thing. Here, hold on, I'll go get it. Hold on a second. Taxes last year, she got paid for two different jobs, $2,744 plus the $350. Then another $100. So basically, she made $3,000 of compensation income plus the $350. So she made $3,350 of income, of gross income. They withheld $178 in federal taxes, $170 in Social Security, $39 to Medicare, and then the state of Georgia another $83. So she didn't get anything from FICA back. She didn't get any of that. Basically, $210. Back from Social Security and Medicare, but she got the entirety of her basically $300 in taxes she had withheld from the state and the feds because she had no taxable income whatsoever after her standard deduction, because her standard deduction was her $3,000 of compensation income plus $350. The child standard deduction, which is up to a maximum of $12,000 in 2018. I hope that makes sense. That's a big deal. I think a lot of people overlook this. If they have earned income, their standard deduction is decreased to the greater of $1,050 or the child's compensation plus $350. Again, they use an example of my man Randy. The child's compensation is $2,400. The standard deduction in that case is $2,750, the $2,400 plus the $350. In Maddie's case, my daughter, she had $3,000 of compensation plus you add $350 to that. So she had a standard deduction of $3,350. Her total income then was nothing. She made, in turn, taxable income nothing because she only made $3,000. All right, second, if the child's unearned income is more than $2,100 under the so-called kiddie tax, the child's investment income, but not earned income, was taxed at the tax rate of one or both of the parents. Complicated rules require the use of the higher income parent's AGI when the parents are, okay, all that, see, that's beyond me. I don't understand that. And Maddie doesn't have any non or investment income because I don't have any savings for her, so we don't have to worry about that. That's one of the things about life insurance, actually. We do have whole life for both Maddie, all four of the kids. We got two $50,000 policies, all of them, and it's all tax-free as the interest accumulates, which is nice. One of the benefits of whole life insurance. The Act simplifies this calculation procedure by removing the parents' and the siblings' incomes from the calculation. Instead, each child's tax is calculated using the compressed estate and trust tax rates rather than the parents' tax rates. The trust tax rates for ordinary income and capital gain and dividend income are set out in the table on page 32. Let's see if it gives us that down here. I'm sure they don't. I guess you got to click on it. I don't really care at this stage here. But anyway, trust tax rates are not good. They're very, very compressed. So let's just put it that way. So you got to be very careful with trusts, what the tax rates are, because they're very compressed. I think it's like $12,000 is the AGI before and in the 37% tax bracket. Just keep that in the back of your mind. And don't quote me on that, but it's like something around there. Let's see. Whether the new approach results in a lower tax under the old law depends on the parents' and child's incomes. The following example contrasts the treatment of a child's investment income under the old and new law. The parents filed jointly, reporting taxable income of $300,000. This level of income subjects them to the 33% ordinary income tax rate and the 15% capital gain rate. The 15-year-old daughter receives $15,000 of investment income from mutual funds given to her by her parents. The child's tax computation is showed on page 32, and I don't see that down here, so I guess I got to click on something, but, oh, wait. Yeah, I don't know. So anyway, either way, I don't see it on here. Anyway, the kiddie tax expectations under the new tax law compared to the old. If the parent's income under the old law was subject to the maximum tax rates, the child's tax would be lower under the new tax law. If the parent's income under the old law was below the maximum tax rates and the child has significantly more than $12,700 in investment income, the child's $12,700, that's what it was, to be subject to the trust 37% tax bracket. That's what it was, exactly right. The child's tax would be higher under the new law. Expect that children would pay less tax on investment income under the new approach, suggesting the use of UGMA accounts and trusts may be very beneficial. Again, this is anything that I have to deal with, and if you're dealing with that in terms of you have a kid who's making more than $12,700 in investment income, unearned income, I highly suggest you talk to a tax person, because that's beyond my pay grade. Frankly, it bores me to some degree in terms I just don't feel like looking up, because not that many people are affected by that I talk to. But if that's you, you need to get good advice on that. Planning strategies under the new law include children with income under $1,050 do not even have to file a tax return unless he or she has net earnings from self-employment of $400. But they should file a tax return because they are going to withhold money most likely. And now if they're just doing babysitting job and all that, who cares? But if they're going to work for another company, washing dishes, they should file a tax return. A child who's potentially subject to the kiddie tax can still receive $2,100 of investment income in addition to compensation income before paying tax at trust rates. The first $2,600 of capital gains and qualified dividends in excess of the $2,100 is eligible for the 0% capital gain rate. So it's possible to have $4,700 shifted from the parents to the kid to make it tax-free. Again, it's a little bit beyond anything that I feel comfortable mentioning because I don't deal with that very often. In fact, maybe hardly ever. But I do deal with children having to pay filing tax returns. I'm like, man, file the doggone thing so they can get that money back. That's $300 that Maddie was using. She got back from the feds in the state of Georgia, which she was spending in Europe as we're sitting here today. When a child's investment income reaches $4,700, consider investments that do not increase a child's taxable income, taxes and municipal bonds. I would say life insurance, absolutely. Irrevocable trial, I don't care about that. If the purpose of the child's account is to save money for college, use a 529, yeah. Including a child's income, I'm not going to get it. I just, should parents claim children as dependents after 18? Okay, so here's after 18. This is pretty important. Under the old law, battles between parents and the child for the child's exemption deduction frequently occurred in the child's early 20s. With the repeal of the exemption deduction and the child credit only being available until the age of 17, the tax value of a parent claiming a child as a dependent after 18 is significantly diminished. All right, just keep that in mind. Under 18, you get under 18, you don't get the exemption, but the kid can earn a pretty significant amount of income and not pay any tax. And you should hire them if you're self-employed. Over 18 years old, it's hard to say that it's more of a value for you as a parent because you don't get the exemption anymore. There's no more exemption. You probably just want to let the child file. Anyway, hope this helps. I'm a big fan of this right here. Randy Gardner, anything that Randy Gardner writes about, you should read without question. Again, I'm not all that familiar with Julie Welch, but She's a CPA, a PFS, and CFP. So I like what they're doing here. But Randy Gardner is one of my go-to guys on all things legal. Smash, comment down below, share, and then we'll see you guys next time. Thanks now, and subscribe if you haven't already.